You know that feeling when you're watching your trade climb higher and higher, that rush of adrenaline as the numbers keep ticking up in your favor, and then suddenly everything reverses and you watch all those beautiful gains evaporate right before your eyes? Yeah, we've all been there. What if I told you that the traders who consistently make money aren't the ones holding out for the absolute peak, but the ones who've learned the art of walking away while they're still ahead? Today we're diving deep into why taking profits early isn't just a good idea. It's the difference between surviving in this market and becoming another statistic. Stick around, because by the end of this, you'll understand why your biggest winners might actually be costing you money. Let's start with something most people don't want to admit. Trading psychology plays a far bigger role in your success than any indicator, any chart pattern, or any trading strategy ever will. The human brain is literally wired against successful trading. Evolution spent millions of years programming us to hold on to things we have and to maximize every opportunity when resources were scarce. In the modern markets, this ancient programming becomes our worst enemy. When you're in a winning position, your brain starts doing something fascinating and destructive at the same time. It releases dopamine, the same chemical that makes gambling so addictive. Every tick higher feels like another hit of that chemical reward. Your logical brain knows you should probably take the profit, but your emotional brain is screaming for more. This is where most traders make their fatal mistake. They confuse a good trade with a perfect trade. Here's a reality check that might sting a little. The perfect trade doesn't exist. The absolute top of any move is only visible in hindsight, after the fact, when you're looking at a completed chart. In real time, when you're actually in the position, you have no idea where the top is. None. Zero. Anyone who tells you they can consistently pick tops is either lying or delusional. The traders who make consistent money have made peace with this fundamental truth. Let me paint you a picture of two traders. Trader A enters a position and sets a target of 20% gains. When the position hits that target, they close it without hesitation. Sometimes the stock keeps running and hits 30 or 40%. Trader A feels a small pang of regret, but moves on to the next opportunity. Trader B enters the same position with the same target, but when it hits 20%, they think, why not hold for 30? Then at 30, they think, why not 40? By the time they finally decide to sell, the position has often retraced back to 15% or broken even entirely. Over a year of trading, guess who has more money in their account? The mathematics here are brutal and unforgiving. If you make a 20% gain on 10 trades throughout the year, you've doubled your account assuming equal position sizing. If you aim for 50% on every trade, but only hit it twice while the other 8 trades turn into break-evens or small losses because you held too long, you've barely made anything despite being right about the initial direction. This is what kills most retail traders. They're right about direction but wrong about execution. There's this concept in trading called the bird in hand principle. A 20% profit locked in is worth infinitely more than a theoretical 50% profit that might materialize. The market doesn't care about your hopes or your targets. It's going to do what it's going to do based on millions of participants all acting on different information in different time frames. Your job as a trader isn't to predict what the market will do. Your job is to extract consistent profits from the moments when the odds are in your favor. Let's talk about something called profit erosion. This is a phenomenon that every experienced trader has witnessed countless times. You enter a position and it immediately moves in your favor. You're up 5% within a day or two. Instead of taking that quick win, you hold because you've convinced yourself this is going to be a big one. Days pass. Your 5% gain turns into 3%, then 2%. Then you're back at break even. Finally, frustrated and confused about how you gave back all those gains, you exit for a small loss just before the position finally reverses and goes in your original direction. Sound familiar? This happens because of market structure. The markets don't move in straight lines. They move in waves, in cycles of expansion and contraction. When you're in a winning position, you're riding a wave of buying pressure or selling pressure depending on your direction. That pressure eventually exhausts itself. When it does, the natural tendency is for the market to retrace and consolidate. The traders who take profits early are selling into that strength before the exhaustion happens. The traders who hold for bigger gains are often holding right through the retracement. Here's where it gets interesting from a probability standpoint. Let's say you've identified a trade setup that has a 60% win rate historically. That means 6 out of 10 times the trade moves in your favor initially. But here's the catch. That 60% win rate assumes you take profits at a reasonable target. If you start start holding for home runs, that win rate drops dramatically, maybe down to 30 or 40%. Why? Because you're now requiring the market to not only move in your favor initially, but to continue moving in your favor without any significant retracement. You've added an additional layer of uncertainty to an already uncertain outcome. The best traders I've ever studied, the ones managing millions or billions of dollars, they think in terms of expectancy. Expectancy is a simple formula. It's your average win size multiplied by your win rate minus your average loss size multiplied by your loss rate. If your average win is $500 and you win 60% of the time and your average loss is $200 and you lose 40% of the time, your expectancy per trade is positive $220. That's a profitable system over time. Now watch what happens when you start holding for bigger wins. Let's say you manage to increase your average win to $800 by holding longer. Sounds great, right? But in the process, your win rate drops to 40% because you're giving back profits on trades that retrace. Your average loss also increases to $300 because you're more reluctant to cut losers quickly when you're in the mindset of swinging for big wins. Your expectancy is now positive $200. You actually made your system less profitable by trying to maximize individual wins. This is counterintuitive, and it's why most traders struggle. More money per winning trade sounds better. It feels better. But the mathematics of trading aren't about feelings. They're about the cold, hard reality of probabilities playing out over dozens or hundreds of trades. The trader who consistently takes smaller profits but keeps their win rate high will outperform the trader swinging for the fences almost every single time. Let's address something important here. Taking profits early doesn't mean you never let winners run. It means you have a plan, you execute that plan consistently, and you don't let greed override your discipline. There's a massive difference between scaling out of positions, taking partial profits while letting a runner work, and just hoping a position keeps going higher because you want it to. Hope is not a trading strategy. Some of the smartest traders use what's called a scaling exit strategy. They'll take a third of their position off at their first target, another third at their second target, and let the final third run with a trailing stop. This approach captures the psychological benefit of locking in gains while still participating in any extended move. It's a compromise between profit security and profit maximization. More importantly, it removes the emotional decision-making from the equation. You're not sitting there every 5 minutes wondering if you should sell. You've predetermined your exit strategy before you even entered the trade. Here's a harsh truth about market cycles that took me years to fully understand. Bull markets don't last forever. When you're in a winning position during a strong uptrend, it feels like the momentum will continue indefinitely. Your brain starts projecting that recent price action into the future. If it went up 10% this week, surely it can do another 10% next week, right? Wrong. Markets alternate between trending and consolidating. They move up, they pause, they move up, they pause. If you've caught a strong trending move and you're sitting on nice profits, the odds are actually increasing that a consolidation or retracement is coming soon. This is where understanding market structure becomes crucial. Support and resistance levels, previous highs, round numbers, these aren't just lines on a chart. They're psychological levels where other traders are making decisions. When your position approaches a major resistance level and you're sitting on good profits, that's often the exact moment you should be thinking about taking money off the table. Why? Because that resistance level represents selling pressure. Other traders who bought higher are finally getting back to break even, and they're going to sell. Short sellers see it as an opportunity to enter. The buying pressure that drove your position higher starts to get absorbed by this selling pressure. Amateur traders see their position approaching resistance, and they think it's going to break through because they want it to. Professional traders see their position approaching resistance, and they start scaling out because they understand probabilities. Sure, sometimes the resistance breaks and the position keeps running, but more often there's at least a short-term retracement. The professional has already locked in profits. The amateur is now holding through drawdown, hoping it comes back. Let's talk about something called recency bias. This is the tendency to weight recent events more heavily than historical data. If your last 3 trades all ran for massive gains after you held past your initial target, your brain is now convinced that holding is the right strategy. You forget about the 15 trades before those where holding past your target resulted in giving back profits. You remember the recent winners and you chase that feeling. This is how profitable traders turn into break-even traders. They let a few outlier wins convince them to change a strategy that was working. The data on retail trader performance is absolutely brutal. Study after study shows that the vast majority of retail traders lose money, not because they can't identify good trade setups, not because they don't understand technical analysis. They lose money because of poor risk management and emotional decision-making. Taking profits early directly addresses both of these issues. It enforces discipline. It removes emotion from the exit decision. It turns trading from gambling into probability management. Think about it from a business perspective for a moment. If you ran a business that made a 20% profit margin consistently. You'd be thrilled. You wouldn't suddenly decide to close the business and reopen only when you could make a 50% margin. You'd keep doing what works. Trading is a business. Your edge is your product. Consistent execution is your business model. Greed is what bankrupts the business. There's also a massive psychological benefit to taking profits that most traders overlook. When you consistently take profits at reasonable targets, you build confidence. You prove to yourself that your system works. You create a positive feedback loop. Compare this to the trader who holds for bigger gains, watches profits evaporate, and exits break even or negative repeatedly. That trader is destroying their own confidence. They're training their brain to associate trading with frustration and regret. Eventually, this leads to emotional trading, revenge trading, and blown accounts. Market volatility is another critical factor that favors early profit taking. In today's markets with algorithmic trading, high-frequency trading, and global interconnectedness, prices can reverse violently and without warning. A news headline, an algorithm triggering, a large institution exiting a position, any of these can turn a winning trade into a loser in minutes. When you're sitting on unrealized profits, you're exposed to this volatility risk. When you've taken profits, that money is locked in. It's safe. It's real. I want to address a common counter-argument here. Some people will say that you need big winners to offset your losses and make real money in trading. This is true for certain strategies, particularly trend-following systems with low win rates. But for most retail traders using swing trading or day trading approaches with decent win rates, this argument doesn't hold water. If you're winning 60 to 70% of your trades, you don't need home runs. You need consistency. You need to protect your capital and let the probabilities work in your favor over time. The compound effect of consistent small wins is vastly underestimated. If you can generate a 3% return per trade and you make 2 trades per week with a 70% win rate, you're looking at roughly a 4% return per week on average, accounting for losses. Over a year, that compounds to returns that would make most hedge fund managers jealous. You don't need 50% winners. You need to show up, execute your plan, take your profits, and repeat. Here's something that separates professional traders from amateurs. Professionals think in terms of risk-adjusted returns. A 20% gain on a trade where you risk 2% of your account is a fantastic risk-reward ratio. A 50% gain on a trade where you risked 10% of your account and spent 3 weeks in the position exposed to volatility is actually worse from a risk-adjusted perspective. The professional takes the 20%, preserves capital, and moves to the next opportunity. The amateur chases the 50% and often ends up with neither. Time is another dimension that matters more than most realize. Every day you're in a position is another day of exposure to risk, another day where news can break against you, another day where market conditions can change. When you take profits early, you reduce your time in market. You can redeploy that capital into new opportunities. You're being efficient with your resources. The trader holding for maximum gains is often tying up capital in positions that have stopped moving, missing other opportunities in the process. Let me share something about institutional trading that retail traders often don't understand. Large funds and institutions don't try to pick tops and bottoms. They build positions on the way up and distribute on the way down. They're taking profits into strength because they understand that their size means they need liquidity to exit. By the time a stock is making new highs and all the retail traders are piling in expecting more gains, the institutions are often selling to those buyers. The smart money takes profits early. The dumb money holds hoping for more. There's also a concept called opportunity cost that plays into this discussion. When your capital is tied up in a position that's no longer moving, waiting for that last bit of potential gain, you're missing other opportunities. The market is full of setups every single day. By taking profits at reasonable targets, you free up capital to capture new momentum plays, new breakouts, new trends. The trader who holds hoping for perfection often has capital locked up in dead positions while the market moves on without them. Let's address the emotional component one more time because it's that important. Fear and greed are the two dominant emotions in trading. When you're losing, fear makes you cut losses too early sometimes. When you're winning, greed makes you hold too long. The solution isn't to eliminate these emotions. That's impossible. The solution is to create rules that override these emotions. A predetermined profit target is a rule. When price hits your target, you sell. No debate, no second guessing, no negotiating with yourself. This is how you win the internal battle that destroys most traders. Taking profits early also protects you from black swan events. These are unpredictable, high-impact events that can devastate positions. A company scandal breaks. An economic report comes in drastically different than expected. A geopolitical crisis erupts. If you're sitting on large, unrealized gains when a black swan hits, those gains can disappear in seconds. If you've been taking profits along the way, you've already already secured a portion of your success. You're protected. The best traders maintain detailed journals of their trades. When you review your trading journal honestly, you'll almost certainly find a pattern. The trades where you took profits at your predetermined target probably show consistent success. The trades where you held hoping for more probably show inconsistent results, with many instances of giving back profits. Your own data will prove that taking profits early is the right approach for you specifically, not just in theory, but in your actual results. Here's a final thought that might shift your perspective entirely. The goal of trading isn't to maximize any single trade. The goal is to maximize your total account equity over time through consistent execution. Some of your trades will be small winners. Some will be medium winners. Occasionally, you'll catch a big winner. But your success isn't determined by any individual outcome. It's determined by your ability to execute your strategy with discipline over hundreds of trades. Taking profits early is the ultimate discipline. It's you telling the market that you're in control of your decisions, not the other way around. Think about professional poker players for a moment. They don't play every hand trying to win the maximum possible. They fold most hands. When they do play, they make mathematically sound bets based on pot odds and expected value. They take down pots when they have an edge. They don't get romantic about any single hand. Trading requires the exact same mindset. You're playing probabilities over time. Any individual trade is just one hand in a long game. The markets will always be here tomorrow. There will always be another opportunity. But if you blow up your account chasing that perfect exit, those opportunities don't matter anymore because you're out of the game. Capital preservation is the foundation of everything in trading. Taking profits early preserves capital. It keeps you in the game. It allows you to compound your success over time. This is how wealth is actually built in the markets, not through hero trades and home runs, but through consistent base hits that add up over months and years. So here's my challenge to you. For your next 20 trades, commit to taking profits at a reasonable predetermined target. Don't negotiate with yourself. Don't try to squeeze out extra gains. Just execute your exits with discipline. Track your results. Compare your win rate and overall profitability to your previous trading where you tried to maximize every position. I'm willing to bet you'll see a dramatic improvement. Your win rate will be higher. Your emotional state will be calmer. Your account balance will grow more consistently. Remember, the market doesn't reward hope. It doesn't reward greed. It rewards discipline, consistency, and risk management. Taking profits early isn't about settling for less. It's about understanding that consistent small edges compound into significant success. It's about respecting the uncertainty inherent in trading and not pretending you can predict the unpredictable. Most importantly, it's about building a sustainable trading approach that keeps you profitable and in the game for the long run. That's how traders truly win.